Imagine applying for your dream apartment. Your income is solid. You have a stable job. You've never committed fraud. You've never declared bankruptcy. A few minutes later, the answer comes back. Denied. No interview. No conversation. No explanation beyond a polite email. Somewhere, a number spoke before you did. You probably never saw it. You probably didn't calculate it. And yet, it quietly influenced one of the biggest financial decisions in your life. That number is your credit score. But here's what most people misunderstand. Your credit score isn't a grade for being a good person. It isn't a reward for working hard. It isn't even a measure of how wealthy you are. It's a prediction, a mathematical estimate of how risky it might be to lend you money based on information in your credit history. And that prediction can affect far more than loans. It can influence the interest rate you're offered, whether you qualify for certain credit cards, sometimes whether you're approved to rent an apartment. In some situations, even the deposit you pay for utilities or the cost of insurance can be affected. The strange part? Most people spend years building a career, building relationships, building savings, yet very few spend time understanding the financial reputation that's being built alongside them. Let's imagine two strangers. Both earn $70,000 a year. Both have stable jobs. Both save money. One receives an excellent loan offer. The other is offered a much higher interest rate. Why? The lender isn't trying to predict who's smarter, or kinder, or more successful. The lender is asking a much narrower question. Based on past borrowing behavior, how likely is this person to repay what they borrow? That single question shapes almost everything. Now here's where the system becomes surprisingly interesting. There isn't one giant computer watching every financial move you make. Instead, many lenders report information about your borrowing to credit reporting agencies. Those agencies compile credit reports. Then different scoring models analyze the information in those reports to estimate credit risk. Think of it like this. Imagine your financial life is a library. Every loan, every credit card, every payment, every missed payment, each one becomes another book on the shelf. A credit report is the library. A credit score is one way of summarizing what's inside. The score isn't magic. It's a shortcut. A lender could read every page of your financial history. That would take far too long. Instead, the score provides a quick estimate, not certainty, probability. And that's an important distinction. A high score doesn't guarantee you'll always repay a loan. A lower score doesn't mean you won't. It simply reflects patterns that lenders have historically associated with different levels of risk. So what shapes that prediction? The biggest factor is usually surprisingly simple. Do you pay your bills on time? Imagine lending money to two friends. One always repays exactly when promised. The other occasionally forgets. Who would you trust next time? The financial system asks essentially the same question. Payment history carries significant weight because past repayment behavior has often been a useful predictor of future repayment. The next piece is how much of your available revolving credit you're using. Suppose you have a credit card with a $10,000 limit. If you're consistently using almost all of it, some scoring models may interpret that differently than if you're using only a small portion. It's not that using credit is automatically bad. It's that constantly operating near the limit can suggest financial stress. Then there's the age of your credit history. Imagine choosing between two employees. One has 10 years of consistent experience. The other started last month. Neither is automatically better, but longer histories usually provide more information. Credit works in much the same way. Time creates evidence. Another factor is the mix of credit you've successfully managed. Credit cards, auto loans, student loans, mortgages. Different types of borrowing create different records. That doesn't mean you should borrow money simply to improve a score. It means the scoring models evaluate the information that already exists. Finally, there are new credit applications. Every time you actively apply for certain types of credit, it can create what's known as a hard inquiry on your credit report. One inquiry is rarely a major issue. Several applications in a very short period may suggest that someone is urgently seeking credit. Again, the model isn't judging your character. It's estimating risk. Notice something interesting. Almost none of these factors measure your intelligence, or your ambition, or your honesty. A brilliant engineer can have poor credit. A wealthy entrepreneur can temporarily have a lower score. A recent graduate with little borrowing history may simply have very little data for the models to analyze. This is one of the biggest misconceptions. People often believe a credit score measures financial success. It doesn't. It measures borrowing history and repayment behavior. Those are related. They are not the same thing. Now let's talk about something that surprises many people. Different lenders don't always use the exact same scoring model. There are multiple credit scoring systems, and lenders may choose different versions depending on what they're evaluating. A mortgage lender may not be looking at precisely the same score as an auto lender. That explains why you might see slightly different scores from different sources. They're not necessarily wrong. They're often using different models built for different purposes. Then comes the uncomfortable math. Imagine borrowing $300,000 for a home. A stronger credit profile may qualify you for a lower interest rate than a weaker one. Even a relatively small difference in the rate can add up to many thousands of dollars over the life of the loan. The score itself isn't costing you money. The borrowing terms influenced by that score might. That's why credit scores matter. Not because they're trophies, because they can change the price of borrowing. And borrowing is woven into modern life far more deeply than many people realize. Homes, cars, businesses, education, unexpected emergencies. Credit can become a bridge between today's needs and tomorrow's income. But every bridge has rules. Here's the irony. Many people obsess over checking their score every week, watching it rise by 3 points, fall by 5, then rise again. Those tiny changes often matter far less than the habits creating them. Financial systems usually reward consistency more than perfection. Years of paying on time generally matter more than chasing every possible point. Perhaps the most important lesson is this: your credit score is not your financial identity. It isn't your net worth. It isn't your future. It isn't your character. It's a tool created to help lenders estimate risk using information in your credit history. Useful? Absolutely. Perfect? Not even close. Every model simplifies reality. No number can fully capture a person's circumstances, discipline, or potential. And yet, this imperfect number quietly opens some doors, and makes other doors more expensive to walk through. Which raises a fascinating question. If a mathematical prediction built from your borrowing history can influence so many opportunities, how many of the biggest financial decisions in modern life are really based on who we are? And how many are based on what the data predicts we'll do next?